Hey guys, welcome back to the Capital Mindset Show. We're your hosts, Austin and Fabio, and today we have something special for you guys where we're going to be kind of breaking down a little bit of macroeconomic concepts. Economics is incredibly important to becoming a good investor and being a good investor. So today we're going to be kind of breaking down the inflationist theory, the deflationist theory, and then the modern monetary theory. And with that being said, let's do this. What are we looking at here today?
Yeah, so just to be clear, that's not even, you know what, we'll do the bonus one.
Let's do the bonus one.
Yeah, but we'll leave that to the end. So we'll do the bonus one.
And so we'll actually, you got to stay for the whole video before you see what the bonus one is.
This is going to be a decently long video, if we're being honest. If we're going to cover, and we're still not going to be able to cover every minute detail of each theory, but we're not going to be taking a side. The goal of this video is kind of just to go over each of the different economic theories and how it pertains to investing, because that's what we really care about. Why does it matter for us in terms of profiting, right? Making money from the situation at hand. So I think the first one, and the one that everyone can kind of relate to the most, it tends to be when I have conversations with individuals, is the inflationist argument. So the inflationist argument, to be very clear, and again, with each individual side that we discuss, and we're kind of categorizing a bunch of economic theories into sides. So for those of you who are economics majors and say, well, that is combining a bunch of things. Yes, it is. It may be combining a bunch of different schools of economics, such, for example, the Austrian School of Economics, and then you can say Keynesian or Chicago style economics. All of those can be kind of grouped into one or the other categories, but you'll kind of see some of their ideologies come forth. But the point is not to really take a side per se. So the first one, again, is the inflationist argument. And basically the inflationist argument is called that by us because they argue that the current system has one pathway forward, which is essentially inflation. And oh, one more thing, Austin here, he's going to be asking questions because he's actually taking a lot of this in raw. So he will actually be like your guide. If he has questions, he's going to stop me and ask me to break things down.
So with that actually being said, literally with the opening thing that you just said, where it's sort of a pathway using inflation, how does that relate? Because there's a typically with a lot of people, they tend to assume that inflation equals bad thing. Is that what you're basically kind of saying here? Or would you break that down a little bit more for us?
Well, okay, so there's the old school definition of inflation, which is inflation is an expansion of the money supply. And the modern day use case of the word inflation basically derives from rising prices. So when a lot of individuals use the word inflation in their dialogue, they're talking about increasing prices. And how that manifests, or how you can conceptualize that within an economics framework, is your dollars or your currency, whatever currency in question, it's becoming less valuable, and the purchasing power, the ability to buy things over time, becomes less and less and less. And all the schools of economics argue different reasons as to why inflation occurs, right? And again, the way I just used it is the modern use case in dialogue. But technically speaking, the old school definition of inflation is simply the expansion of the money supply. So I want to make sure I represent those people who will probably say that in the comment section, or who go by the old definition of inflation. I want you to know that I know that. So for the most part, I want to point out an economy that my birth country, Venezuela, and I'll just go over during I think it was 2018, Venezuela was the best performing stock market in the entire world. What do you think about that, Austin?
Well, it sounds interesting.
Yeah.
Being honest with you, because I was actually about to just ask you just now as well. What are some of the roles, if you were going to cover this later, what are some of the roles that quantitative easing might have in the inflationist argument here?
I'll actually get to that, because that's later down the line for the inflationist argument. But
Perfect,
for the purpose of Venezuela, what happened was basically with hyperinflation, as the value of the currency went down in nominal terms, the nominal price or nominal value, and keyword nominal, I'll explain what that means in a second, for assets went up. And this actually currently happening in Lebanon. It happened in Iran. So if you watch actually some YouTube content of individuals who go to Iran and they kind of interview the locals, one of the most valuable assets became used cars. So used cars appreciated drastically in the local currency. Now, what did I mean by nominal? Well, there's a difference between nominal and real, and that will continue throughout this video. So I want to explain that real quick now. Real basically includes the devaluation value. So it accounts for the devaluation of the currency. But when we talk about nominal just means, the price of something doubled, right? The price of something doubled, so the value went up, but it's not accounting for the devaluation of the currency. So in nominal terms, the Venezuelan stock market did really well that year. But in real terms, it actually went down 99%. So if you compared it to the US dollar, so if you priced the Venezuelan stocks in US dollars, they went down 99%. But if you priced them in Venezuelan bolivars, they did the best in the world. So you see, all about kind of like Einstein's theory of relativity, that kind of attributes itself to economies as well. It depends on what you're valuing it in. So Austin, your computer back there, if I value that in pebbles, right, that'll be different than the value in current US dollars or gold or et cetera. So
or Bitcoin.
Exactly. It's relative to what we're talking about. So in Bitcoin terms, the value of your computer is done really poorly because Bitcoin, by comparison to other currencies, has appreciated, and more or less dollar has been kind of stable. Well, for Americans, 5% inflation is a lot, but for a lot of other countries, it's not that much. But the inflationist argument basically argues that QE is inflationary, or QE will cause inflation, and QE stands for quantitative easing. I think everyone who's watching this video has probably heard the term at some point or another, and probably knows what the abbreviation means.
Yeah, would you briefly define what quantitative easing is for maybe some of our audience who might not know what it is, just in like a simple 1 or 2 sentences?
So I'll go into greater detail later, but simply put for now, quantitative easing is basically a Federal Reserve monetary policy that, and difference between fiscal and monetary, but monetary policy that is supposed to be stimulative to the economy and encourage certain behaviors, and is in theory supposed to assist the economy in increasing growth and lending, etc. But the inflationists are arguing from the perspective that QE is inflationary, and I'll actually circle back to the inflationist argument, because actually you're going to have to hear the deflationist argument, because there's a second half of the inflationist argument that coincides with the deflationist narrative, and I'll explain how they coincide. But I'm kind of covering only half the inflationist argument right now, and then we'll come back after we hear the deflationist argument. But a lot of inflationists will talk about something called the QE trap, right? So the QE trap, you can kind of resonate with this when you look at 2018, when the Federal Reserve tried to ease off with their interest rate policy, and we had the correction in the stock market, and immediately they had to reverse course and again cease their interest rate hikes. And that is actually what the inflationists point to as the QE trap. And the QE trap was actually coined before that happened, so don't think that they coined it after the fact. They were actually a lot of economists were addressing this point, that once the Federal Reserve engaged in QE 2 and 3, that we would end up in QE forever, because the economy would become dependent on QE. And the belief is that the Federal Reserve cannot change policy going forward, and that the Federal Reserve is essentially trapped in just endlessly doing QE. And it includes not just the Federal Reserve, but the Central Bank of Japan as well. So, and the ECB. So everyone's kind of stuck doing QE forever. Yes, Austin, give me your question.
My question, in your opinion, Fabio, do you believe this to be the case?
I believe that there is strong evidence that can support that.
Yeah.
Yes. So now we go to the question is, why does this matter for your wallet? Why does this matter for your investing principles going forward? Well, it's important to be aware that if an action can cause a mass devaluation of said currency, that you need to take steps, or that can change your investment profile. So an investor would need to take that into consideration and be very wary as to what kind of investments they'll make. So we kind of drop little nuggets here and there. For example, when we did our Unum video, if you go check that one out, that we talked about how insurance companies, a lot of their investments are in bonds. So in the case or in the scenario of an inflationary environment, the value of their bond portfolios will be destroyed. And depending on the nature of how they're organizing their policies, they may be liable for more than what the value of those bonds will be, because maybe it just depends on the policy, or maybe not. Perhaps the policy will not cover the full cost arising, for example. So it just depends on the industry that we're talking about, and in terms of like how macro meets micro. But you want to be aware of that. And then in an inflationist argument, the investment approach could be focusing more on commodities and stuff that cannot be replicated or just simply created out of thin air, because those will tend to hold value if the need necessitates it. So think of energy, think of other forms of commodities that are vital in the industrial space, stuff like that. So that is the investment profile that fits in that narrative. Any further questions before we move on?
Yeah. So my other question here would be, in that instance, then what situation would actually, like, which party would be benefited in an inflationary situation? Let's say, for example, because a lot of people tend to kind of have this opinion that inflation is bad for everyone, but is that necessarily the case here? Or is there potentially a party that might actually benefit from higher levels of inflation?
Those who hold debt, for sure.
Okay.
So debt holders, so those who have purchased assets with debt will have the greatest benefit, because not only will the assets rise in nominal sense, remember nominal versus real, they'll rise in nominal, but the debt they have to pay back is actually, that one in real terms is becoming less valuable. So in real terms, it's getting less valuable, and in nominal terms, the asset is rising, perhaps a little bit in real as well. The real will depend on like the nature of the demand for that asset. But in nominal terms, for at least that, the asset will be rising. So for example, let's say you have a rock, just a rock, because I don't want to get into specifics of commodities, but you have a rock, and the rock is valued at $10,000, and you borrow $10,000 to buy this rock. So if the rock goes up let's say we have 100% inflation, the rock, let's ignore demand for the rock. Let's keep it constant. The rock will be you can sell that rock for 20 grand, but you borrowed 10 grand for said rock. Okay. I know it's kind of funny. We're using a rock as an example. It's kind of ironic, but so if you were to go to sell this rock, you would pay back the 10 grand, and you'd pocket the difference, which was 10 grand, and you would have 10 grand that you never had before. So while the 10 grand did go down in value, you didn't have that 10 grand. You basically were gifted 10 grand in that scenario. That's like in this perfect world. Okay. So for the most part, that's what you can kind of think about: assets, and then those who borrowed money. So basically the wealthy would benefit in an instance of inflation. Those who do not have assets, or those who cannot borrow will and have savings, primarily savings, they will be hurt by inflation.
Yes, no. Go.
So actually, and I want to actually cover that a little bit, because the textbooks, at least sometimes when I worked in my tutoring business, I would go over some students who were taking either IB economics or IB history, stuff like that. These kinds of courses, these college level courses, they would be taught that inflation was beneficial to the lower classes and detrimental to the higher classes, because they went from the argument that interest rates were lower, not interest rates were lower, sorry. The savings was less attractive, and savings would harm the upper class, and therefore inflation was detrimental to the upper class and beneficial to the lower class, which is kind of foolish. And I remember kind of thinking like, wow, is this what they're really telling them?
Yeah.
which is
Well,
kind of interesting.
yeah. And then kind of to piggyback off of that as well, like since now we're dealing with the party that are primarily holding debt that would benefit in these
Yeah.
inflationary environments, what role could variable interest rates potentially play in said structure that you just defined here? Is that something that's even a concern, or
Oh,
is that something that isn't necessarily a huge concern because of exactly what you just described in the preceding example about that rock?
well, in a perfectly free market, the interest rates will reflect or will rise in accordance with inflation.
Yeah.
We'll get to more on that about what QE is doing there, but like in inflation, a rise in inflation, the investor or the lender is not going to want to lose real value. They're
Yeah.
not going to give you free money. So they're going to want to be compensated for that risk of that loss. So the inflation rate, if the inflation rate rises in a perfect world, or not a perfect world, but in a perfectly free market, the interest rates will rise as well. And if you have variable rates, that
Yep.
they would rise in that sense. But
Yep.
there's a little more nuance to that. Just like with everything in economics, there's a lot of
Mhm.
complications. It's a lot of armchair economists out there, but it's very difficult to fully pinpoint this. And there's a lot of different opinions and a lot of different studies. But we're going to get into the deflationist argument, and the deflationist argument, if you kind of stuck with this so far, everything has been pretty easy, pretty straightforward to explain. This is where things get really complicated or difficult to explain, especially in this kind of setting. But I'll do my best, and I'll provide graphs later on during the deflationist argument to kind of get over. So Austin, you got to stop me if you have a question, but I have
Oh,
a
yeah.
book here to organize my
You
thoughts
bet
so I
I
don't
will.
ramble. Okay, so this is
Yeah.
to stop me from rambling.
Mhm.
But basically, let's start with QE and start explaining and break that down what QE is. So
Mhm.
basically, the deflationist argument is that QE is not money printing. Okay, so separate from a lot of inflationists who argue that QE is money printing, deflationists argue that QE is not money printing. And they go into, or the arguments presented are a little bit more detailed as to why that is. And it has to do with, we'll use some basic accounting equations within the commercial banking system and the central bank system. But for the most part, that's the initial premise. QE is not. And in fact, QE is in fact trapping money. This is where things get a little wacky for some people, but QE is trapping money. So there's a couple things that you need to know with inflation, and it kind of again coincides with the inflationist argument. Is that inflation is both a function, right? A function of the money supply and the velocity of money, right? So, or the money multiplier. So what that basically means, everyone can kind of grasp the money supply. It's the supply of money, but the money
Yeah.
multiplier. So let's say Austin gets paid $10, and then he gets this $10, and then he goes and buys other things, and then that person goes buys other things, and that person goes buys another things. If this continues down, for example, like 5 times, you can more or less say you have a money multiplier of 5, right? So you have a money multiplier of 5. So the higher the money multiplier, the actual greater the effect of the inflation. So if you have let's say you have a negative money multiplier, in theory, like just in theory, then it doesn't matter what the M2 growth rate is. You're always going to have deflation in that sense. So you gotta consider both factors. So if money multiplier goes up a lot, but I'm sorry, reverse that. If the M2 money supply is going up a lot, but the money multiplier is decreasing below 1 and it's trending towards 0, then you have a not deflation. You don't have hyperinflation. You won't get hyperinflation. So you need both. And that's again, we're going from the deflationist argument. So I can kind of showcase real quick from
I actually have a question here.
Give me your question.
You've noted to me before that in some of our calls, there's been sort of like a push from the deflationist argument, sort of oriented towards treasury bonds. Would you kind of give a brief overview as to what that kind of entails, as well as how that kind of plays into this theory itself?
Okay, so in basically, to spoil a lot of what's going to go forward, but the investment thesis behind the deflationist argument is you actually want to take advantage of what this future demand for currency will be. And
Yeah.
a lot of deflationists, actually, I'll say that later. I'll say that later. But the strategy that they employ is basically buying up treasury bonds on the longer end of the maturity spectrum. And they are trying to play the decline in interest rates that they expect to follow through deflation, through temporary deflation, that keyword, temporary deflation. So
okay.
yeah,
That
so
makes
that's
sense.
why they would be wanting to buy bonds. So if you believe deflation is going to occur, disinflation or even deflation, then you want to actually own bonds and not assets, because assets do bad. Well, financial instruments such as stocks will do bad during a deflationary market. During inflationary times, they'll do great in nominal terms, right? And you want more or less stability, but we're not explaining that. But this right here is you can see this, right, Austin?
Yep.
All right, so this is a graph real quick of the US money multiplier, or the M2 money multiplier. And you can see here, this is the financial crisis of 2008, 2009. And we can see that it declined sharply during this recession. So this is actually in the midst of the ramp up of QE again. Right, so lowering interest rates from the years 2000s, et cetera. But this is now going to be the ramp up of QE. And this data, of course, comes from Standard & Poor's, from the St. Louis Fed economic data. So what we're looking at here is just a quick example of something that can occur. And the inflation rate of the United States, okay, let's just assume that the data is correct. So I know a lot of people out there will say, well, I don't trust the Federal Reserve data. It has been quite low, and the growth rate of the economy has been quite low since about this time. And I'll actually go over that a little bit more with Dr. Lacey Hunt's research. But I would like to first explain the mechanics of QE. And this is, again, well, I wasn't lying to you that this is probably the most difficult part to explain versus the inflationist narrative. So I'll actually use the formulas that they provide here, which is more or less nice. So this will help me visually explain to people. So assets, this is what we can kind of talk about with central bank reserves. This is the key word, actually. So QE essentially, before we get into this, I'll just explain this so we can just focus on this. QE is essentially an accounting change between the central bank and the commercial bank, or a bank, right? Whoever has accounts at the Fed. And you have an asset on your account, right? So what assets would you have in your account? You would think bonds, right? Bonds, mortgage-backed securities, but let's focus on government bonds. So government bonds will be exchanged and put on the reserves asset, so the Federal Reserve's balance sheet, and in exchange, you will get what's called a reserve asset, okay? So remember that word, reserve asset.
Mm-hmm.
So going back, we take a look at this simplified formula, right? So assets is equal to reserves plus banknotes in circulation plus government deposits. So government deposits, we'll worry about that later. Banknotes in circulation, take out your dollar bill. There you go. That's your banknotes, right? And then reserves are those assets on the commercial bank's balance sheet. Okay, so let's also explain real quick, because the context is necessary. And do you have any questions so far? Because
No,
this is where I expect people to have a little bit of trouble.
Yeah, I'm just kind of taking a look at this and just really trying to kind of grapple with this sort of system as a whole. So basically what you're saying here, in the term of reserves exist as, pretty much for simplicity's sake, an agreement between these commercial banks and the government institution itself. And then through this is
but yeah,
the central bank.
Yeah.
And then through this is basically how money is put into the economy. Is that basically what I'm looking at here? Just summarizing what the audience might be thinking as well.
Very good question. I was probably going to explain this right now, but so it's good you asked it. Money is put into the economy through debt. We're a debt-based system. So let me get this out so we're not distracted by that. But yep.
So if we're a debt-based system,
Mm-hmm.
then when people say, oh, we want to pay down the government debt, is that even possible to do?
Yeah.
For it is? Okay.
Yeah,
Okay.
it's possible to do. So I'll actually go into private debt versus government debt later in the deflationist argument, because that's actually very important. That's a lot of Dr. Lacey Hunt's focus. But there's a lot of problems that are involved there. But basically, a debt-based system just means the creation of money revolves around the creation of debt. So, but debt is created by the commercial banks, not the central bank. The central bank actually doesn't create or formulate or enable new debt. That's not how it works.
Okay, so that probably ties back into then the entire concept of what you were talking about with the reserves, where it's basically, if I'm understanding this correctly, the commercial banks are the ones that create the debt, but then, okay, so that's actually starting to make sense to me then, if that kind of makes sense.
Yeah.
All
So the commercial banks are the real creators of money. They actually create the money. And the Federal Reserve is like the bank of the banks. Okay, so they have a relationship there. Now I'll go into there'll be a last. Yep, continue.
I've also got another question. I got a lot of questions.
No, good. Ask questions. This is the part where most questions.
So we're a debt-based system.
Yeah,
we can pay down the national debt.
Yes.
Why aren't we doing it?
I'll get into that. Yeah. So there are so I'll get into why debt is kind of important. So here's a separate argument within the deflationist argument that I wasn't actually going to cover, but I'll cover now because I thought it was a little murky. But so one explanation for that is that the current system relies on the liquidity of the short-term borrowing. So a lot of the government debt is done on the short-term end, a lot of it, like a crazy amount. So for example, so think of you as with your credit card, and then you borrowed money with your credit card on the short-term interest rates, and let's say that they are higher in that sense, but they're not for the government because the government is the risk-free asset. So government bonds are the risk-free asset in the finance world. Whether you agree with it or not, that's the classification because the rules are set up by the government, and so the government has decided that their assets or their debt is the risk-free asset. Because if you can sit there at home and imagine that you're able to declare or make up the rules, and then you say, oh, my credit card debt there's no risk to it. That's what the government's able to do. So government short-term debt is considered less risky more than the long-term. So you'll always see a percentage interest rate differential, and it's less risky on a payback period or on an inflation basis because you're getting it closer. Yep, you have a question already.
No, so my mind is kind of grappling with this now. Okay, so if the government is defining risk-free assets, and they're making the commercial banks buy these risk-free assets, then that then explains how these commercial banks are then creating debt in essence into the economy. Because they're legitimately buying these risk-free assets from the government.
And it's not only us or not only the commercial banks. We are the world reserve currency of the world. So in a lot of ways, the United States has to get its currency out there to be utilized in whatever capacity. So a lot of that does actually revolve around the debt, actually.
Which that also explains too why, just a little bit, kind of diving beneath the surface here, that also explains why our influence is so substantial throughout the entire world. This isn't a big brain take. I mean, anybody knows the United States is a major world superpower, but that truly explains, at least from an economic perspective, why the United States is where it is. But
it's more of it's actually not, that's the reason. It's more of, that's one way that they are maintaining it. They were trying to maintain the reserve currency status, and that comes with some level of responsibility in the form of providing liquidity. So what I mean by liquidity is they must provide these short-term bonds and sell them. So in a way, the government must create tons of debt, tons of these bills. Now, here's one way to think about it. And the inflationists, and I was supposed to structure this so I didn't go backwards, but I will, because the inflationists would say, well, the government is borrowing a lot on the short term. So if interest rates were to rise in the short term, it could cause a problem in that sense. And that's the QE trap, like we were talking about. So if rates were to rise, we can't raise interest rates, basically, is what that means. Once the debt gets past a certain level, and because so much of the debt is borrowed on the short end, the QE trap one of the parts of that is that the interest rate rising too high would cause problems with paying said debt, which I'll go over a little more in the deflation argument. But
yes,
for the most part,
let's get back to asking
we want
again,
to cover that the central bank balance sheet basically has assets on one side and liabilities on the other side. So liabilities for the central bank include reserves, banknotes in circulation, and government deposits. So if you take out your dollar bill, you'll see that it's a Federal Reserve note, right? So your dollar bill is a liability on the central bank's balance sheet. It's a liability. And the assets on the central bank balance sheet includes what the things they gave the commercial banks reserves for. So they'll have government bonds. Now they have mortgage-backed securities, et cetera. But think of assets as like they buy these debt instruments, and that's what they put on their assets. So reserves are the key to this argument between the deflationists and the inflationists. So inflationists, in order for QE to be money printing, the commercial banks need to be fully borrowing or lending against the reserve assets. So if they're able to do that, then they have a huge argument there. The deflationists disagree with them, to maintain myself on the deflationist argument, that the reserve assets, they do not lend against them. So that's where, when I said at the beginning of the deflationist argument, to structure going back to that, that QE is trapping money, or it's a money trap. Okay, it's a money black hole. Some of them describe it that way, because they cannot lend out against the reserve assets. And I'll go over that a little bit. But reserves go up or down if the banknotes in circulation, the central bank's assets increase, right? So they go up if it increases, they go down if it decreases, right? So let me explain that. Did you get that?
yes,
Explain that correctly. Yeah. So again, if the central bank increases its assets, the reserves go up. If the central bank decreases its assets, the reserves go down, right? That's one way that reserves can go up and down, right? Based on that. Or there's another way. Another way reserves can go up or down is the public decreases, right? If it decreases, reserves go up. The public decreases the amount of bank notes it wants. Okay. And how does it go down? The reserves go down if the public increases the amount of cash or bank notes it wants. Okay. Does that make a little sense? So you go to your bank, you take out your dollars, right? You take out your dollars, you hold them, and you take them out of the banking system. You will actually cause a lowering of reserves. You'll cause a decrease of reserves. Yes, that's an example. And we'll go over some like debt examples, but here's another one. So again, reserves go up or down if the government reduces, right? So this is for the up argument. Reserves go up if government reduces its deposit at the central bank. Reserves go down if the government increases its deposits at the central bank. Okay, so you don't have to hunker down on those three, but those three are the ways that reserves can go up or down. And reserves are going to be very important because the reserves are a huge part of the deflationist narrative. So reserves remain parked at the Fed unless demand changes for cash, right, on the public sector. The public being you, me, everyone watching this video, all American citizens, everyone who wants dollars. And then the reserves remain parked at the Fed unless this other scenario, government does make net payments to private sector.
So, okay.
Net payments to private sector, meaning pays more to the private sector than it collects.
Okay, so what I'm looking at here is
this is a lot to absorb.
A multifaceted cake.
Yes.
In the way that reserves go up and down.
Yeah.
So big brain take here. This is a very, very complicated economic process here.
Well,
and that's
yes, macroeconomics, very complicated.
Which is the reason why, at least where my mind goes, it's so integral that one gets good at understanding these particular things if you want to be a great investor. And my next question for you now is sort of like, what's what's a way that if you could put into like 3 main points, sort of short, brief, to the point, 3 main points, what's a way that you could just summarize in total the deflationist argument as it pertains towards these reserves, and then also the way that the economy should overall conduct itself, if that's even a position you can sort of take here? Because where my mind goes with this, there's usually a camp of people that say, oh, it needs to be done in this particular way. This is the one way to do this. Economics, it doesn't exactly look like that's really the case. It kind of looks like it's a legitimate, multifaceted, multi-layered cake. So again, like 3 main points you could really just easily, quote unquote here, easily summarize the deflationist argument in regards of to what the economy as a whole, the way it should be operating.
It's not the way it should. So they're arguing the way it does. Right. So again, they'll say point number 1, QE is not money printing. Point number 2, commercial banks are the source of money creation. Point number 3, reserve assets cannot be lent out in the way that people think they can be. In fact, they may be causing the velocity of money to go down. And then I'll go into Dr. Lacy Hunt, but that I will leave it at that for reserves and all that, because I think it will overwhelm the viewer. And not only that, it's also too much to take into one video, so we may have to make a second video if everyone wants that. Comment below. But what basically I'll want to go over Dr. Lacy Hunt's more of his findings and some of his arguments, because his is more like unique and very explicit within this sector. And then we'll go into modern monetary theory. And again, we'll summarize why each one's important as to your investments. And actually, we can go over some specific case studies of investments I made last year.
And I think we also have to go over the bonus as well.
Yes, the bonus. So
this is going to be a long video.
It is going to be a long video. It's going to be a long video. But basically, what Dr. Lacy Hunt basically went over was the problem with the United States right now is the debt itself. It's the high amount of debt. And I want everyone to think a little bit is that debt is future demand for said currency. So let's say if Austin owns $1 million, he has to, pay back this debt, right? And he has to get dollars in order to pay back the debt. If he didn't have any debt, right? If he didn't have any debt, he doesn't necessarily have a future demand for dollars. He could demand euros, right? So if his debt is in dollars, but he's earning money in euros, he still has to convert to dollars to then pay off his dollar denominated debt. So he still has demand for dollars, right? Him individually as an individual. So debt, you can think about it as future demand for dollars. And that inherently it involves or causes a lot of other problems, because by spending, you're spending, right? And this is actually where the deflationists and the inflationists agree. If you spend money you don't have, you are spending your future income. Okay. So the deflationists they're simply arguing that the debt itself is going to cause slowdowns in economic growth. And I want everyone to go look to see, do they have some merit to their argument? Has economic growth slowed down in countries and continents where the debt has skyrocketed? We're going to take a look at Japan, the United States, and the ECB. But first, I actually want to show everyone a graph. And this kind of tells us the current trend, or the break of trend between real GDP per capita, what we would have if we normalized the growth between 1870 and the year 2000. So that's the blue line. So the blue line is if we follow trend. The black line is what really happened. And what's stark about the black line is the gap now is 17.1%. So we are 17.1% below trend. And what we would have otherwise had has been just broken off. So statistically, something's wrong. That's just telling me something's wrong, because we wouldn't just break off trends so radically, right? And what you can correlate this data with is the debt. So in fact, the debt highly correlates with this data, this breakage point. So from here, there's a lot of other things that Dr. Lacey Hunt highlights, but the biggest problem that is highlighted is something called unproductive debt. So unproductive debt, let's give an example using Austin. I'm not to pick on you, Austin, but you're making some bad investments here. But let's say Austin buys a house, right? He takes on a loan and he buys a house and he's losing money on this house. Austin, what would not be a solution? Probably borrowing a ton more money and replicating your first mistake. So instead, let's say he's exactly. Let's say he's getting a cap rate. Exactly. Let's say he borrows money and he's losing $300 per month on his investment property because it's the rent is $300 less per month than what he's paying for the debt. So if he does this and he replicates this and to a larger scale, he's not going to be any better off. So what we call that is unproductive debt. It's kind of a tangible example you can put your hands around. So unproductive debt can be very dangerous because it doesn't produce a net positive or the net positive that replaces the value of the debt that you took on. So remember that money is just a representation of value. That's all it is. It's really all it is. It's a tool that societies use to represent value so we don't have to do a barter system. So if you are grabbing this money and putting it to a use that is producing less money, what you're doing is basically using your money inefficiently. And how you know that is you're getting a negative return for said money. That's the free market kind of telling you that you're doing that. So if you go out and borrow money, buy an asset that's producing less than what the servicing costs are of this debt, you are basically, we call that bad or unproductive debt. And